Well, the Reserve Bank has announced that it's going to extend its bond purchases, what economists call QE, so you can think of it as QE 2.0, because they've been buying bonds since late last year. So they've announced that they're going to buy another $100 billion worth of government bonds when the current program of purchases is due to end in April. And so they're doing that just because they want to support the economy. The economy is recovering, but the bond purchase will give that little bit extra to make sure their recovery keeps going. Well, the Reserve Bank has needed to do more QE, more bond purchases, because it's got a goal of full employment. What it means by that is that it wants to see the unemployment rate with a 4 in front of it. If it gets the unemployment rate that low, it's going to get wages growth back above 4%, and that'll be fast enough to get inflation back in the 2 to 3% target range that it wants. The difficulty for the bank is that we're a long way from seeing the unemployment rate that low. We calculate a policy rule at CCI to give us a guide at where the cash rate should be. It tells us that we should actually have negative interest rates in Australia, a cash rate of -3 or -4%. Obviously, we're not going to see that. The RBA is unwilling to deliver that. It's got the cash rate at 0.1%. It's got the target for the 3-year bond yield at 0.1%. It doesn't want to go down the path of negative rates. And so with the banks not willing to draw on the cheap money that the RBA is providing through the term funding facility, this points the RBA in the direction of having to do more QE. The other thing which is giving them a nudge along is that we're in a situation where, even though the economy has done better than expected over recent months, coming out of recession, wage growth is still, or wages are barely growing. And so at this point, with the currency going in the wrong direction for the RBA, that they need to do more bond purchases. I think they'd be particularly frustrated by the higher currency. When we look at the bond deals we participate in, the bond issues by, say, the Victorian and Queensland government, we can see a strong demand from foreign buyers, and that's contributing to the higher dollar. The difficulty for the bank is that the RBA is that our bond yields are still very attractive compared with other countries, and so they need to do more in order to get the currency lower and support the economy. Well, at CCI, we were forecasting that the RBA would announce another round of bond purchases, QE 2.0, you could call it. And so we thought that they would deliver on a further $100 billion of bond purchases to support the economy, and that's what we've got. The market actually had a different view, and so it was surprised by the Reserve Bank's decision. You had the market expecting that they would buy fewer bonds, roughly $60 billion, and the market had thought, was surprised that they were making an announcement as early as this month. But when we looked at the RBA, we didn't think that we thought that they had all the information they needed. The information was telling them that they're still a long way from achieving their goal of full employment. Currency is going in the wrong direction for them, and so there was no need to wait so they could act. If anything, we're still thinking that given the scale of the task, the difficulty in getting unemployment back into the 4% range that they're aiming for, we could see further bond purchases once this extension expires in September. And so you could see a QE3, as you could call it, down the track. Well, the Reserve Bank has said that they're going to keep the cash rate at 0.1%, which is the slowest what they want to go, until 2024. We know from history that it often takes several years to get the unemployment rate as low as in the 4s, which is where the RBA wants what the RBA wants to achieve. The last time it was there, you have to think back to before the financial crisis, so it's a long time ago. And in the meantime, if the RBA is keeping the cash rate that low, You've got other central banks around the world still pumping out easy money. They're supporting the budget deficits in their countries, supporting their own economies. And that means there's going to be ongoing upward pressure on the Aussie dollar. So given that pressure and given the difficult task of or ambitious task of trying to achieve full employment, that to us suggests that they could do another round of bond purchases down the track. With the bond purchases that they announced late last year, we think that they are immensely important in supporting the market and supporting the economy. The trouble for the RBA was that when they started the bond purchases, there were stronger forces going in the other direction. And as a result, we've actually looked at the real exchange rate, for example. It's actually risen over the past year, so it's gone in the wrong direction for the RBA. So the counterfactual is that if you hadn't had the purchases that we've had in recent months, the Aussie dollar would be higher still and bond yields would be higher still. You could almost think of the first round of bond purchases being an experiment for the RBA, and so they were learning what the effect was of their actions, because this is the first time they've ever done anything like this in Australia. And so the lesson we think that they've drawn from it is that the bond purchases weren't large enough. And so that comes back to our view that they needed to announce additional purchases, which they've done, and we see the risk of, we believe that there's more purchases to come down the track. The benefit of having more purchases down the track is that sometimes people worry that if you've got all this easy money in the economy, that you're going to see problems emerge in the housing market or financial stability risks. But the QE, we think, is a clean way of avoiding that because the main way it acts is through the bond market and then through the currency. And so you're not having any direct problems coming up in the housing market as a result of going down this path. Inflation is very low at the moment. If you think of the trend in inflation, it's the lowest we've seen it since the 1960s. And so the Reserve Bank has an objective of trying to keep inflation between 2 to 3%. It's been missing on that objective for several years. And the reason behind that is that the labour market's not tight enough. You could think of it as the unemployment rates just too high to generate the sort of wages growth we need. Wages during the pandemic are barely growing, and so the Reserve Bank is trying to get inflation higher by reducing unemployment. It wants to get to full employment, which it thinks of being as an unemployment rate in the 4s, and in that way it'll get the wages growth picking up, get wages growth back above 4%, something we haven't had since the 1990s, so a long time ago. And in that way, it'll eventually get inflation picking up. It's a difficult task for them. They were missing on this objective before the pandemic, and to us, it just reinforces the message that they've had to deliver more in the way of bond purchases, given they don't want to adopt negative interest rates in Australia, and we could see more bond purchases down the track, just given that. Even though the unemployment rate's fallen, it's going in the right direction, it's just going to take a long time, we think, to get low enough to get that wages growth picking up and getting inflation back up.